So the US debt situation is getting from bad to worse. Now the big beautiful bill is coming and we're going to stack an additional $3 trillion to the national debt. And that's a very conservative estimate as well. Now there's a reason why Ray Dalio tells everyone to focus on the US bond market, because if that breaks down, so does the entire US economy. Consumers are already facing higher prices from tariffs, and the last thing they need are borrowing costs going up. But that's exactly what's going on today. Now, since Trump took office, real rates have been rising. US 10-year yield is almost 1% higher than shorter term notes. In other words, investors are demanding a higher return because US paper is going to get inflated away. Borrowing costs in the real US economy, like mortgages, are now higher by 1% or more. So if you're Scott Bessent, you are sweating. You probably can't sleep at night, even if the big beautiful bill helps US households save 5 grand or 6 grand on taxes. Higher rates will more than wipe that out. On national TV, Bessent is appearing to be really calm. He's trying to explain away why higher yields are normal, that it's not related to the $3 trillion deficit from additional spending from Congress, that global rates are jumping because that's the trend today. What we are witnessing is just a coincidence. No, Mr. Secretary, that's not normal. It's a global crisis because US bonds, which underpins the entire financial system, are imploding. It's a key reason why the price of credit default swaps on US bonds have risen to the highest level since 2008. Speculators and investors, they are worried about the odds of a default. They are trying to buy fire insurance when a house is already burning down. And this isn't debt from some distressed company. It's treasury bonds issued by the US government. So this is a major crisis that's still brewing. To really checkmate Bessent, we need to focus on what he does and not what he says. He's painting a rainbow for us because he has to, but his policy actions all point to a treasury panic. Now, Bessent is going full Wolf of Wall Street mood. He's moving to ease the capital rule on US treasuries this summer. He's going to allow US commercial banks to buy more US bonds without the need for collateral. And if this passes, the big boys can buy a boatload more of US debt without raising more capital buffers. But can we all remember what happened just 2 years back? Why do you think SVB collapsed in the first place? The bank loaded up on long-term US bonds and it was a disaster when rates flew to the moon. And there's no guarantee this time that it won't happen again. Now, Bessent's plan is simple. He's trying to mobilize commercial capital, use the bank's money to soak up the additional supply of US bonds. Now, this is a very desperate move because Trump and friends, they are out of options. And really consider the backdrop. The Dream Team is going to borrow an additional $300 billion annually. In addition to that, Trump wants to wage his trade war until everything burns down. So a U-turn there is impossible. How about money printing? Isn't that the playbook? The Fed did it in '08 after Lehman Brothers collapsed. Powell also printed money again during Trump's first term. Well, that option is also impossible. From the 2024 peak, dollar strength has declined by 10%. So US imports from the world are now much more expensive. How much more pain can US consumers really take? Higher prices to people is as good as higher inflation. Meanwhile, asset managers are all betting against the US dollar. People on Wall Street aren't exactly dumb. They know the additional spending is going to put tremendous pressure on the dollar. So the Trump White House is cornered. Even if Bessent backs Powell day and night, the Fed is not going to print money. The only option left is deregulation. But once again, we need to highlight how risky this situation is. Bessent is willing to risk a systemic crisis in US banks to paper over this overspending. And we cannot underestimate how serious the problem already is. Now, US banks are already sitting on $480 billion worth of paper losses. That's almost half $1 trillion. It's an increase of 33% from the previous quarter. And now that rates are rising, the losses are piling up once again. So what happens if the reserve ratios are relaxed? Well, US banks might chase profit and just go crazy. Okay, they could buy even more bonds to squeeze out more gains. So yes, yields might start to come down, but unless the overall fiscal situation changes and the trade war stops, this buying isn't enough. Should yields reverse and spike back up, the banks will be sitting on even bigger losses. Now, Bessent has been giving us clues all along that the plan is higher inflation. He cannot control the debt situation anymore, especially when Donald Trump wants to keep spending.
So we think that we can both grow the economy and control the debt. And what's important, Bill, is that the economy grows faster than the debt. So what I would tell your viewers to focus on is what I'm focused on, is what Secretary Yellen was focused on, is what is the total debt to GDP? Because we can grow our way out of this. That if we change the growth trajectory of the country, of the economy, then we will stabilize our finances and grow our way out of this.
But what if Bessent is wrong? What if the US economy can't outgrow its debt? Should inflation make up the bulk of the GDP increase, it could still result in bond yields spiking even higher. We are in a very dangerous position because Bessent needs yields to calm down. The US government will have to refinance over $7 trillion worth of treasuries maturing this year. And if it doesn't do it fast, it will destroy America's productive capacity. The interest payments will snowball out of control. And if we need further evidence of this panic, Bessent just delivered again. Remember the US Sovereign Wealth Fund, the crazy idea that we said was unfeasible all along? Trump has confirmed that the idea has collapsed. It will be rotting on the shelves because the US debt is the real emergency here. The focus today will be on paying down the debt. This is a confirmation that the debt situation is now a crisis. The Wealth Fund was supposed to be America's economic strategy to reshore industries. Now, as we know, US supply chains are heavily fractured. Trying to manufacture without cheap inputs is like playing golf with one hand tied behind your back. Here was the original plan: monetize US government assets like gold and use the proceeds for investments, and this includes stakes in critical minerals projects. However, the plan just isn't feasible. If you monetize your gold reserves, you will doom the US dollar, and borrowing money to fund your wealth fund is also extremely risky. The collapse of this idea is a pivotal shift that tells us how dangerous the situation is. We can remember how excited Trump and Bessent were about this idea, but they are now willing to sacrifice US supply chains to pay down the debt. Now, is there another way out of this quandary? Well, according to Penn Wharton, yes, but Trump won't like the answer. This will sink his entire presidency in 60 seconds. And let's take the first three scenarios. Trump can immediately stop the deficit imbalance by increasing taxes by 14.6% and cut expenditures by the same amount. Or he can keep spending and raise all federal taxes by 33%. And that would mean destroying people's earnings even further. Domestic consumption will collapse. Another way is to reduce all government spending by 26%. But that would mean defaulting on social obligations and reducing the military. Is that even feasible today? Any of these scenarios could outright trigger a US recession. In fact, it would be worse. It would be a major depression for years to come. And that's why inflation is the lesser of two evils. So one way or another, Trump has to ensure the bond market doesn't break, or it would be game over for the entire economy. However, there's another external shock coming for US debt. And the bad news keeps piling on, and it's really a side effect of Trump's own trade war. The collapse might be triggered by a US ally. Now, Japan just lost their top creditor status for the first time in 34 years. And this is groundbreaking, especially if you're an investor in US assets. Now, imagine if China lost their position as the world's factory. This is almost as serious as that because Japan's main export isn't really cars or anime films, it's their capital. For many years, Japan has been exporting their capital to the world. Now, the yen was weak, and Japanese bond yields were near zero, so investors were sending their money abroad to chase yield. But in 2024, Germany has actually overtaken Japan. They have the most external assets globally, and unlike the Japanese, they diversify more instead of putting it all on the US. China is also a big creditor to the world, but once again, they also spread their bets across the global economy. Japan is different, they really love US assets. There are multiple reasons why US asset prices are just so high today, and a big part is the money printing and constant deficits. But foreign money has been pushing everything, including US stocks, to breakneck levels as well. According to Goldman, US equities are at crazy valuations today. That's despite the recent correction. The S&P is trading at 21 times price to earnings, the highest in modern history. The Nasdaq is also priced at massive valuations. We are at 26 times price to earnings as well. US stocks are supported by a ton of money flowing in, not just from American investors, but foreigners as well. It's the reason why Trump's trade war is just so risky, not just for exporters and companies, but also to financial markets as well. The global economy is so interconnected that breaking world trade will also cripple US asset prices, and this relationship is vital to understand. Should tariffs escalate once again, so will the fall in stocks and bonds. The US economy today enjoys a massive capital surplus, which means money from all over the world is entering US markets. Now, that's a good thing for investors. Money flowing in pushes up asset prices. It's why bond yields were so low and the Max 7 are such ridiculous levels today. But thanks to the Dream Team, tariffs are destroying exporter earnings. Foreigners have less dollars to invest back in the US. Now, Trump wants to reduce the US trade deficit. That's doable, but it will also mean destabilizing US financial markets. There's always a trade off when your economy is so hyper financialized. As a result, suddenly the capital surplus starts to drop, liquidity dries up. We have a situation where stocks and bonds starts to fall in price, or at least they stagnate for a long period of time. So Japan losing their position as the top creditor in the world is a problem. They hold a ton of US assets. Japan is no longer the go-to safe lender of last resorts. More local money will be heading back to the country because at least there's no currency risk there to be had. Everything is denominated in yen. So we have to watch interest rates in Japan really carefully. The higher it goes, the bigger the reversal of capital will be. And it's not a small amount. In fact, it's downright terrifying. Between 2013 and 2023, Japanese investors were the biggest in the world. In less than 10 years, they bought up 50 trillion yen worth of overseas investments. And should this reverse, it presents a massive problem for global markets. The US, of course, will bear the brunt of the pain. This is the effect of the yen carry trade unwinding. The era of borrowing cheap yen to buy US bonds is also coming to an end. Liquidity there is going to dry up. The question is, what are Japanese investors going to buy now? More stocks in Japan, maybe more gold. Whatever the case, this is bad news for US yields as well. Now, since 2023, Japanese investors have been exclusively buying US bonds. They thought it was the gold standard amongst all global debt. They avoided EU bonds and Asian bonds as well. They have over $1 trillion worth of exposure today. Imagine what happens if that starts to unwind. The effects will be really horrendous. Yields could spike up, trying to stabilize the US economy will get that much harder. That's why, as we said before, Bessent can't really afford to be nasty to Japan. Trump wants to act tough, but punishing Japan today might mean punishing your own bond markets as well. There are many trigger events that could smash US assets lower, and Japan's exodus of money is one big risk. But let me know what you think. Does Bessent really have a plan? And will global investors take their money and go home? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.